Every day we ask Wall Street's brightest minds to share the word they believe will describe the trading day ahead. Victoria Greene, what is your WEX word of the day?
Yeah, mine is judicious. I think you got to be very careful and prudent about how you're investing right now. And you need to make sure data's coming at you fast and furious. Make sure you're sidelining those emotions and really dealing with facts. You know, do you need to stay? Does your conviction need to change? Do you need to update your thesis? As we're getting a look under the hood at Q1 numbers, it's very easy to become emotionally attached sometimes to our holdings as investors. And you need to be looking with data, not with panic. Sometimes it's not smart to trade on a knee-jerk day, but you also need to update. Okay, let's say we have new headwinds. Let's say we saw something different on revenue numbers come in. Just look at it, be prudent, and be fact-based in your investing. When data's flying around, you need to be smart and calm.
All right, judicious. I like that word. So, Vic, looking at the Dow, not just the Dow futures, but the futures overall right now, the Dow's down about 140 points, but the Nasdaq's the hardest hit, down 1%. A lot for investors to chew on, as we just said. We heard the Fed governor say, the New York Fed governor say some pretty hawkish comments, and also we're hearing Janet Yellen talking about the relationship between the U.S. and China. How do you see these two factors shaping this trading day ahead?
Well, since earnings, especially the banking earnings, haven't been what I would classify as a complete dumpster fire, now our focus shifts back to the Fed watch. And so we are looking at these statements being made. It does look a little more hawkish. You know, June's now on the table. That was unthinkable a month ago. It was maybe one in May and done. And then if Yellen really escalates what's going on with China and we see more and more pressure there and economic tensions rise, it just kind of ratchets up the risk on the downside. I also think some of this is a reaction to the Tesla mix, especially on the Nasdaq side. You know, if you look at the breadth of the market has been really poor this year. So you've had some of these winners really driving the market up, but they're accounting for an outsized portion of the overall returns. And seeing Tesla kind of miss them pretty hard is shaking some investor sentiment, especially on some of these tech stocks that have had that massive run up since October.
All right, something else you're watching is the dollar. I'm looking at the dollar right now. It's down about 1.5% so far this year. And that's leading you to one of your picks, which is Pepsi. So how does the falling dollar help a Pepsi?
So they're a very international company. More than half of their employees are actually international employees. And I think in Q4, they're around 43% of their revenues were generated from international markets. So when you have a falling dollar, you actually were going to generate stronger, by the time you do your currency translation back and you look at your financial statements, stronger earnings for Pepsi. So we see this dollar headwind. We see that now that might be a bit of a dollar bear market, which is good for these multinational companies. We also think Pepsi is a little bit higher quality and more insulated because it's not just a beverage company. It's also a massive snack company, and we're never giving up our snacks. So if you're looking for a little bit of an area to hide in the market and in staples, it's not necessarily cheap, but they're a high quality company. They've got a very strong track record for setting reasonable earnings expectations and beating.
All right, one more of your picks is Schwab. That name's been a bit beaten up lately. Why are you so positive on it?
Okay, it's not that bad, people. Everybody likes to hate on Schwab right now. And I'm like, it's really not that bad. Yes, they're seeing this cost of deposit rise, but so is every financial. They have mentioned multiple times they are not going to have to sell their held to maturity. They could lose all their deposits and still not have to sell their held to maturity. Every financial is going to be facing these new potential regulatory headwinds and rising costs in there. But I see Schwab as highly diversified. They continue to gather assets. Any market lift is good for their asset management and their fees. And so I look at this company and I say it's just a different balance sheet. And I think it is actually attractive valuation after all of this turmoil. And I think their vision for growth in the future is still very much intact. Every financial is going to be facing that headwind of maybe we have higher regulatory costs, maybe we have different regulatory margins.